Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 1st, the beginning of a new month, and welcome to this week's In the Know Trader Show. Well, as we record late morning, we've got the S&P down about 36 points. Bond yields are falling precipitously again. The 10-year is just under 1.72%. That's down about 12 basis points from yesterday. Crude oil flying up $8 and WTI at 103.65 or so. Huge move there. What else do we have here? Bitcoin up about just shy of $2,000. And the US dollar is also significantly higher today at 97.34. That's the US dollar index, up 64 pips. And even despite that big move up in the dollar, gold is up about $30 too. All these headlines, everything with Russia and the Ukraine is what's pushing the markets in every direction. And we'll talk a fair amount about that today. So let's take a look at what we've got on tap. We'll talk about how to trade a high volatility environment. We're certainly in one now. The VIX is at 32 right now. We have not seen, VIX stay over 30 for any amount of time in the last year or so. So we're certainly in a high volatility environment right now. The market overview section, we'll take a look at the Dow Jones Industrials ETF, the US 10-year yield chart, which is the TNX, and then GLD gold, which has been breaking out and continues to push higher. And then we will this week get to what we couldn't and didn't have time to get to last week, which is taking a look at the 11 macro sector charts, materials, communication services, energy, etc., down the line, so we can see internally. We look at the S&P as a whole, but let's take a look at which charts are better and worse within the 11 macro sectors, and kind of if any new signals are about to be found. To sign up for the weekly ETF Tactical Trader Report that we put out from In the Know Trader, please go to inthenowtrader.com. Just last night, we also put out, it was February 28th, the end of the month, we put out our monthly 7-11 report. That report uses anywhere from 5 to 7 of the 11 macro spider ETFs, the ones we were just talking about that we'll go over chart by chart, to be invested in to outperform the S&P with the goal of staying away from underperformers. And if you can allocate properly and stay in outperformers, or even ones that are neutral to the S&P but avoid the underperformers, you will outperform. Now, outperforming is something very few people do over time. So let's just talk about what we did in February. With the market down, we lost money too, but we lost less than the S&P. We, in fact, outperformed by 82 basis points in February. Since our fiscal year started, which is every August 1st, so since August 1st of 2021, we are ahead of the S&P by 2.22%. And since we started this in August 1st of 2020, we have outperformed the S&P by 5.67% in those 19 months. That type of outperformance would put us in the top decile of all money managers out there on the street. So if you're looking to do better than the market, you think that trading individual stocks is very difficult and it's a tough game, and then you want to be in the S&P or the Qs. In this case, we specifically center on the S&P, and we are outperforming by, as I say, 5.67% in 19 months. That is huge outperformance. That puts us in the top 10% of all people who play this game. And that's what we'll tell you about 7-11. My email address, rick@inthenowtrader.com. Best and easiest way to reach me. All right, let's take a look at what's going on. Second, risk management as a key focal point. We spent the entire show last week on that. If you missed it, go back to StockCharts.com or YouTube and catch last week's show. It is very helpful to understand how important money management is, and I gave you a whole bunch of different tips on how to improve your money management skills. So for this week in a high volatility environment like we have now, cut your trading size down. If you normally trade $2,000 per position, cut it in half and trade $1,000. You're still going to get the huge moves, but cutting down your size will offset some of this volatility. Secondly, widen your stop outs, whether they're sell stops on buy orders or buy stops on sell orders. And of course, always try to put them in non-obvious places. The more you put a sell stop or a buy stop where other people are going to do it, the higher likelihood you're all going to be taken out. Now, there are some people who tell you that stops are not worth putting in. Last week, I caught a video of somebody who's got a huge following on social media, and she said, don't use stops, they're a scam. Well, she's a great marketer. She's got a boatload of followers, but she does not have a heck of a lot of practical trading experience. In fact, she'll tell you she doesn't get out of stocks. She simply buys them for the long haul. So, if she buys a stock at 100 and it falls to 50, she's still in it because she's thinking long-term is the way to invest. To tell people that stops are a scam and it's just a way for the brokers to make money off of you shows me how little actual practical knowledge she has of the market. So she sells courses, she does all this stuff. And again, she's got a great marketing background and she's terrific at getting people hooked. But when it comes down to it, she has virtually no practical trading experience whatsoever. So I don't at all agree with that stops should not be used. If you remember back when we had talked about the NASDAQ weekly cloud chart, and we had shown you that 4 times in the last year, a pullback to the baseline was the low of the move. And we said, if it breaks the baseline, the game has changed. And certainly we broke it in, I think it was January, possibly even December, to not have stopped yourself out on, a certain amount of your portfolio would have been silly. And, just for people who say stops are nonsense, they are not traders by any sense of the imagination. Third bullet point for today, learn how to use options to limit risk. The options market is a terrific way of playing the market and limiting the risk that you have. The seller of an option is essentially like an insurance company. They're collecting premium. They hope that what you're paying that premium for doesn't happen, but if it does, they pay you out, and you get advantage of having had that option contract. So I don't want to go into a deep conversation about how to use options themselves. There's great stuff on the web. Take a look at Tony Zhang, Z-H-A-N-G. Look at his videos from optionsplay.com. Plenty of good stuff there on how to use the options market. But what I will tell you is, especially when we have a high volatility environment, it is often better using the options market. You can buy a call, which gives you the right to exercise in the future at a specific price, the ability to, let's say, buy a stock. So if a stock's trading at 100, you can buy the right to buy it at 100 in the future. If you want to, you pay a certain premium to have that right. But if it doesn't happen and stock goes to 90, you're not going to want to, at that expiration date, say, yes, I'll pay 100 for it, because you could buy it in the open market at 90. You pay a certain premium to have that right. But if it doesn't go your way, you just simply lose your premium, versus if you bought the stock at 100 and it went down to 90, you've lost 10%. This is a way of limiting how much you can lose if you buy an option. How much you can lose is known from the beginning when you get into that contract. They are very, very useful tools to use. So I highly suggest learning about the options market to limit what your risk is. And you can play them on the bullishly. You can buy a put, which means that you are bearish and it gives you the right to be a seller of a stock at a certain level. You can also use them in the sense that if you're long a stock at 100, you could buy a 95 put, meaning that if it gets below 95 at expiration, you have the right to be a seller at 95. Oh, lots of different ways to use options to help reduce your risk. And there's also, you can be the seller of the option. And you can do something called selling an option spread. And this way you can be the collector of a premium, but you also, by doing the spread, you reduce the risk because you'll take in a certain amount of money for being the seller. If you think that that price is not going to get achieved, you can be essentially the house by taking in the option, the premium or the insurance company. But you can also protect yourself that if you're wrong, let's say you sell an upside call, and that means you don't think the price is going to get up there, but you can buy a higher strike upside call in case you're wrong, and then limit your loss to the difference between the strike prices minus the premium you took in. Lots of ways to use options to trade. There are some people who only trade using options and never take the risk of just simply having an outright position in the market. And then the last bullet point that we're going to talk about is stay short term. No one knows where this market is going to be in a month from now, let alone 3 to 6 months. You'll hear pundit after pundit on CNBC tell you that, we're close to a low. Of course, they told you we were close to a low a month ago. They're virtually always bullish. Doesn't matter to me if they're always bullish, always bearish. Nobody knows where we're going to be in normal times, let alone when the world is under the pressure, and the markets are under the pressure of what's going on because of Russia and Ukraine, and to a large extent, what we're really talking about is Putin and what level of sanity you want to consider him at, and how far he will go not to lose. And he seems like the type guy who hates losing and will go, doesn't matter what the cost is, and doesn't matter what the human life cost is for him to achieve what he wants. Therefore, stay short term. When the market, I think it was Friday or Thursday, the S&P had a 4.5% range intraday from high to low. That's what the futures had. You don't need to put on a position to hold for 6 months or a year, because we have no clue, and there's lots of money to be made on very short-term trading, right? In a couple of days now, you can make or lose a lot of money. So that's why you want to use sell stops if you're long, to limit your downside. But I can't tell you to buy any stock now and tell you that in 6 months from now it's going to be higher. We just don't know. And even in the energy space, which looks like it's flying, if all of a sudden something positive came out of Russia, along the lines of reducing the conflict to some degree, whatever it is, you could see oil fall $20 in a second. So, and that of course would drag, the Exxons and all the names with it. So, stay shorter term. Think about, multi-days to a week or two, because you just can't figure out much beyond that right now. And that's my thoughts on how to manage yourselves during a high volatility environment. Let's go to charts and see what they are saying. We're going to start with here's the Diamond, DIA. This is the Dow Jones Industrial Average ETF. Important stuff here. We're in week 7 towards a possible 9 count. We are back to where the lows were in January as well as June of last year. We're kind of sitting there right now. The bottom Bollinger Band is here. Now we are tucking into the weekly cloud, and obviously last week we were much lower than this, but when all was said and done, we actually closed just above the top of the cloud, still holding support. When we look at this now, this would be the lowest weekly low going back to June of last year. And if we fall any further beneath this line, and this line is at 332.5, then you have your lowest close going back to first quarter of last year. So closing under here still keeps pressure on, makes me think that you want to sell rallies against the conversion baselines as well as the middle Bollinger Band. They will probably, you can see the middle Bollinger Band is starting to turn lower. So even though the upper one is turning higher, the lower one is turning lower, which says that we're increasing volatility. I would expect to still see some resistance around there on any future rallies. But what, of course, becomes more concerning is the market got a good low last week, but we're still not being able to notice. We also essentially stopped at the top of the cloud this week. So we're in the cloud. We're kind of in no man's land, but this is still getting a little heavy, and it's only Tuesday this week. The week isn't over, so we don't know where the weekly close is going to be, but it certainly looks like this week is going to close less than the close from bar 3, keeping it at bar 7. Next week only has to close beneath 347 and change. And then a few weeks from now under 341.01 to finish out the 9 count. If we got a 9 count, the closer it is to the bottom of the cloud, the more likely I do, bottom fishing there. The Qs actually bottomed last week. It was bar 8 for them, and they went exactly to the bottom of their weekly cloud. In fact, let's just show it to you. Notice here. So Qs went all the way down to the bottom. This is a week 9. To me, I would think that if we pull back enough towards the bottom of the Bollinger Band, it's a better buy than just going for it right here and now. But, market's still under pressure, and you're going to have resistance overhead. In fact, if these 3 levels right here, top of the cloud, conversion line and baseline, you've got a little zone in there that, is your first level of resistance at this point. All right, let's take a look at US 10-year. So this peaked on a setup 9 count, 9 weeks in a row. The close was above the close from 4 weeks prior. That's what topped the market. It topped the market in October last year. It was pretty darn close to topping the market in March of last year. It bottomed the market, in this case, 9 consecutive Friday closes that the close was less than the close from 4 weeks prior. Nailed the all-time low. Nailed the subsequent low. So these 9 counts are important, and even as we're talking now, yields are on the low for the week, and they've pulled back. There will be some support here, the breakout of the neckline. So you might get a bounce here. That's down towards 165 or so, 164 to 1.67%, give or take. And you've got the uptrend line from all-time highs beneath there. So big turnaround. We said it was a crowded trade. We told you that even though I think later this year, yields can go to 2.16 and ultimately 2.5. Last week, we told everybody who reads our stuff that bonds likely had a peak in place, or 2 weeks ago it was, and that they were likely to pull back, especially because it was such a crowded trade. And everybody was saying yields had to go higher. Let's take a look at GLD, and then we'll get into the sector charts. So let's see, do we have it up here? Yep. So here's gold. I am going to so you'll see that when a trend line breaks, I change it myself from a solid line to a dash line, because it just makes it easier for me to see stuff. Now the last downtrend line you can draw is this magenta colored line, and we are through it, but the week's not over yet. I'll assume that we'll close above there, but on Friday, if we close above here, I turn this into a hyphenated line, and then we have nothing left as far as downtrend lines that you can draw from all-time high on the weekly chart. There is no proper downtrend line you can draw that is still intact. So that's clearly has bullish implications. The fact that the trend line held recently, so I needed these 2 points, the low here to the low here, created the line. We stopped on it then. We stopped on it, 5 weeks ago or so. So this looks good. We have stalled against prior highs and a propulsion exhaustion level, but if we take those highs out, we're early in this count, if I'm not mistaken. So here, yeah, we're on a week 5 here, so there's still a bullish bias here for at least another month. But of course, the higher gold goes, the harder it is to figure out where you would stop yourself out. If you came, even if you came in, let's say now at 180, where's your sell stop? Well, There's nothing nearby. To me, it's down under, it's down underneath this low here at 167.03. That's what you've got to risk. So that's 13 points away or so. So it's a fair amount at this point to risk that much, but that's what it is. To me, there's nothing in between that would really suggest that gold could not still go higher. And now let's move to the 11 charts of the macro sectors. We will start with XLB. I tend to do these in alphabetical order of the ETFs. So here we go. We've had some upside exhaustion signals since last summer. We extended a little past, did not take out the stop level. So they're still active as suggesting tops. We've been bottoming against the top of the cloud. Take, here, let's make this trend line. If you were to take these lows out here, which are now triple bottom, take out last week's low, you're probably going down to 75, the bottom of the cloud right now. Resistance is, again, between the base and conversion lines. XLC, communications services, much shorter price history, all-time high on a sequential signal. We're really on a key level now. Last week's close, or 2 weeks ago close, so the low close of the move was right here. This blue line touch, this is the lagging line touch at the top of its cloud. We rallied a little bit last week, we're pulling back. So here we are again, come through here, and chances are we're going lower. So right about where we are now, let's call it 67.28. It's about 40 cents lower than here. If we close beneath there on Friday, then we're probably heading down for the next couple of weeks. And look at MACD just, decimated. XLE, energy, flying. Let's just put a trend line here and see what we've got with this. So trend line held also multiple times, breaking out to the upside. We are above that high here, but we're kind of toying in here. The one thing that concerns me a little bit is the 9 count, where people are really coming back to energy, and it's been an under-owned name for a heck of a long time. And it's finally getting interest again. Financials concern me just because they're pulling back. To me, we're clearly going to go touch the top of the cloud, if not test the low here from September on a further move down. Look for 34.75. This looks toppy for now, especially with interest rates doing what they're doing and coming in. Industrials. We didn't reach the bottom of the cloud. We're still in the cloud, kind of no man's land, but we've got resistance right above from the top of the cloud. I'd say this is also somewhat vulnerable, and you've got to probably get multiple closes above 103.80 to get this looking better again. It's still been, sideways for a long time before breaking down. XLK, 9 count, maybe closer to a bottom. Tough call here. At least we hit the propulsion exhaustion level on the way down, so that was important that we hit that. XLP, Staples, one of the best looking charts. We're closer to the all-time high in Staples than virtually any other of the charts, so this is still looking good, and there's an uptrend line here that's still intact. If it falls, it'll come and test the top of the cloud to this propulsion level. XLU, utilities, kind of sideways. There is a minor upward bias here, higher highs, higher lows on an 8 count here. Actually, not much I really come up with here, so I'm not going to. XLRE, real estate. So we're holding to the top of the cloud here. If this breaks, then look for probably about 43-ish next, and then the bottom of the cloud. XLV healthcare, spike high here. We're at the bottom end of the range. If these levels get taken out, boom, we go all the way down to 118.67 or so. So big thing to watch for. And the last one, XLY. Again, trying to hang to the top of the cloud, already hit the bottom last week. If we can't hold here, then we're probably coming back to the bottom of the cloud. That's it. Hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.